It was the only option, but don't make me.
Hard time seeing what's up there. All right.
Yeah, exactly. Yeah, that's like what's going to be at house.
All right, well, thanks for coming, everyone. We are just gonna go ahead and well, I don't know, Erica, did you want to say a few words since?
Sure, I'll get us started. So the Small Business Program is happy to partner with the SBDC and the Highland Cedar to bring you today's program. For any of you who haven't attended before, the hub is funded by a federal grant that provides support and services to small businesses throughout the central UP and in-person programs like this. Unfortunately, we don't have any in-person businesses today. Those of you who joined us online, Tina and Devin, welcome. We're happy to have you here. And with that, turn things over to, well, before I turn things over to Lance, I'll let you know who's in the room here with us. Should we have anybody else arrive? My name is Eric Huss. I'm the program manager for the Small Business Support Hub. We also have Nicole Hussman from the SBDC and Derek Hoffman from SBAM's Small Business Support Hub. He is the Small Business Resource Navigator as well. And many of you know Alana, our Small Business Resource Navigator for Schoolcraft, Elgin, and Delta counties. And with that, we'll turn it over to Lance.
Well, thank you so much, Erica, for having us today. Nicole, thanks for being there. And our director here in the Upper Peninsula, Daniel's with us as well. So we are the Michigan Small Business Development Center. Our services are free. They're confidential. We're funded by several sources, starting with the Small Business Administration from the federal government, and then the Michigan Economic Development Corporation, or MEDC, here in the state of Michigan. Our headquarters is in Grand Valley State out of the Seidman College of Business. And then around the state, we are hosted by universities, colleges. And in our case, our host is Michigan Tech University. And we cover the 15 counties of the Upper Peninsula. And then the rest of the state is covered by their other individual regions here. So again, we're free, we're confidential, we're here to help small businesses. And yeah, so today, and here's our team, our director Daniel's on, myself, a consultant, Kevin Mannanen up in the Keweenaw areas, another business consultant with us, Nicole, of course, our marketing person, and then Mariah on the eastern end of the UP, as well as our three interns from Michigan Tech University, Sabrina, Maya, and Maya. So we're looking at a screen, lots of numbers, looks confusing. What is it? It's the numbers coming in and out of our business. So how can we even understand what we're seeing from all this gobbledygook that's on the screen, right? Doesn't make any sense. So what we're going to talk about today is the importance of understanding your financial reports, the profit and loss, also known as the income statement, the balance sheet, and the cash flow report. So these will be the three we speak about. Why do we have to understand these three reports? Why is it important? Well, how are we going to make any decisions if we don't understand what these things mean, these reports? How can we make a decision to maybe get a loan and purchase more equipment or bring on more employees? Possibly. And then additionally, we've got to comply. You know, in the end, our financial records are going to be what we're going to need to file our tax returns. Also, maybe our financial institutions, if we have a bank loan out there, they may want to see these periodically to see what is the health of the company, of the business. So where do all these numbers come from? Our bank account statements, our sales and our receipts, the invoices that we issue to our customers expecting payment. Many people start off with spreadsheets, Excel spreadsheets, which oftentimes work very well to gather the information, But the big concern is can you look at that information in a spreadsheet from a profit and loss, balance sheet and cash flow standpoint? So spreadsheets are good, but being able to actually generate the reports as well. The information also comes from our depreciation tables from the assets that we have purchased, that we've put into operation within our business. In the accounting programs that we use, like QuickBooks is pretty much the flagship. There's things like Quicken out there. There's Wave apps. So there's different accounting programs that are out there.
Lance, can I ask a question?
Yes, sir.
So if a business owner tells you, you know what, I have a business bank account and I can look at my activity online, like I can look at my transaction history, isn't that enough to understand if my business is doing well? What would you say to that?
Yes and no, maybe. The problem is, again, it's not categorized and put into the format to where you can really deeply analyze it. It's not enough. Am I right?
Oh yeah, I agree. But that's what I hear from business owners often is like, hey, I don't think I need an accounting program. I don't think I need to help, get help creating these financial statements because I have my bank account. But the problem there is that the bank account just shows money in and money out. It doesn't tell you the why. And the why is what the accounting programs are doing for you. Statements.
So let's talk.
Helps you break sorry, so essentially what we're saying is it helps you break down, say, what we're spending on rent, utilities, inventory. So it's not just what's in and out, it's how you're spending what goes in and out.
Exactly.
Absolutely. How you're categorizing it, right?
Now, one example would be, let's say that I want to invest $10,000 into my business idea. If I deposit $10,000 into my business bank account, if you're only looking at the business bank account, you see $10,000 increase. It doesn't say that I did it. It just shows like the business has now $10,000 that it didn't have before. You don't have any way to know from the business bank account statement, was that sales that I made? Was that money that I invested? Was that a loan that I took? So the business bank account by itself is not enough. You need an accounting program or spreadsheets or some way to produce reports off of, okay, what happened there? Was it sales? If so, that's subject to income tax review. That shows profitability. If it was money I invested, there's no income, no expenses, no profitability. It's just money that I put into my business account. So there's no taxable consequence there. If it's a loan, then that would be a different type of report. That would be your balance sheet. So yeah, the business account statement is not enough.
Good deal. So let's talk a little bit about profit and loss. Another terminology that's used is the income statement. We're looking at a time range, maybe say from January through October, whereas opposed to a balance sheet, we're looking at a snapshot point in time. So we're looking at a time range with the profit and loss. And what it's going to tell us is what were our sales? What were the costs to pay other people in order to get those sales? It's the profit and loss thing, and we'll get into the detail of it, but wear and tear, depreciation. How much are we going to claim as depreciation on the profit and loss? What's not included on the profit and loss and income statement are like Daniel had just said, the owner investments or draws, any loans, investment that's been made into the business. So we won't see that on profit and loss. By the way, your year of end profit and loss at the end of your cycle, the end of your year, that's basically going to turn into the document for your tax returns. So if we look at the time range right here, what do we see on a profit and loss? We see this date range, January 1st until October 18th. We see the income coming in, the sales that the business has had, the cost of goods sold. So what we're going to talk about here a little bit, we're going to look at a couple of different reports, but in this case, let's just assume that this is a bar, restaurant, brewery. So our cost of goods sold would be, well, we had to buy food in order to sell it. We may have had to buy cases of beer or barrels of beer in order to sell it. So that's our cost of goods sold. So if we take our cost of goods sold, $1,000, and divide that by our sales, well, it looks like we're at about a 33% cost of goods sold, which for the industry that we're talking about, this is a pretty good number because that's what it should be. And then the inverse of that would be your gross profit, your income minus your cost of goods sold, divided by your income, which gives you your profit margin. Then we'll have our operating expenses, which would be our overhead expenses, which will then tell us what is our net profit. What are we going to get taxed on? Any comments, Daniel, Nicole, or?
Why is the date range important? Like if you say you're looking at a statement and the first thing you should do is look at the date range, why?
Because we need to put it into perspective. For one thing, there could be some seasonality of sales. We want to know because later on we may want to compare them to other date ranges. Do you got something in mind, Daniel, specifically?
No, it just I mean, like if you're looking at this statement, why care about the date first? And I mean, I think I agree with you. It's just like because you want to know what time range am I talking about and why. Like if your accountant says, "Hey, we need to file your 2025 tax returns," you want to make sure that your profit and loss statement that you're giving to your accountant covers that date range. You don't want to pull something that's the wrong date range or that's missing dates.
Excellent. So let's look
Oh,
at
I do have another question about dates. Is a profit and loss statement that covers just one day useful in your opinion? Or what would be like the minimum time range
not
that you think would be
not
useful?
not really. I don't think one day is one day, 1 month is 1 month. But I would say at a minimum quarterly to look at them quarterly, biannually, and then the end of the year. Would you agree?
Yeah, I generally recommend that people look at it on a month basis at a minimum. And then, so it'd be like monthly, quarterly, and annually. I think that's a good pace. If you go anything shorter than a month, like you just said, like, okay, on one day you might buy materials, on another day you might not. So it's hard to understand whether you're actually profitable as a business just based off of one day or even 1 week. There are businesses though, like grocery stores that have high volume, high turnarounds, like large grocery stores, they will often have a weekly profit and loss review because they're buying stuff every single day. They're selling stuff every
Continually.
single day. So that might be, but for like, I don't know, like if you're a retail store, it's probably not critical to review a profit and loss statement by day. It would probably be more useful by month.
Good
One
point.
thing I like about one thing I like about the accounting software too is it lets you look year over year. So you can look at the same
Yes.
time period last year and see how you were doing. And it's harder to do if you don't have the right software.
Yeah.
Good deal. True. So let's look at a vertical analysis up and down. We have the time frame. What were the sales? What was our cost of goods sold? And it's important again, cost of goods sold. So to monitor that on a profit and loss, because are you within the industry standards? Is your cost of goods sold too high? Or is it too low to where it just doesn't make any sense, which could be an indicator that maybe you're not keeping good records? So after we take our sales minus our cost of goods sold, we have our gross profit. Then we get into our overhead expenses that never really go away. Things like insurance, interest expense. That would be interest that we would be writing off for tax purposes on the debt that we have. Things like office supplies, rent expenses, and we don't have a lot of them on here, but usually there's 20, 25 of them. Overhead expenses, things that never go away. So then there again, we see our net profit. And again, what we're looking for as far as industry standards is our net profit as a percentage of total income. are we in that ballpark compared to our sister businesses within the same industry?
Is it better to have high net profit or low net profit?
I'll let somebody from the audience answer that question. Better to
Well-
have a high net profit or low?
I'm sorry, could you repeat the question?
Better to have a high net profit or a low net profit?
I think you should have a high net profit.
The higher the better.
That's right.
So-
Lance, can you talk to me about what net profit margin means?
Well, what can you explain it a little bit, Daniel, for people maybe? Because you're a little stronger in bookkeeping than I am.
Sure. So net profit margin is the idea that for every dollar of something that you sell, you're able to keep a certain amount of that after all your expenses at the end of the day. So your accounting program is telling you, okay, if I did sell $3,000, so this is what this statement is showing me, and at the end of the day, I was left with $925, excuse me, in net profit, I was able to keep $925 out of 3,000. So if you do that calculation, that's called a net profit margin, and you'll see the little percentage below. So it's 30%. My net profit was 30% of my sales. And if you think about that in the terms of a dollar, you're saying I was able to keep 30 cents on every dollar that I made from a customer. If you ever see that you have a negative net profit margin, so your expenses actually exceeded your sales, you could have a negative net profit margin, and it might be like negative 10%. That would mean that for every dollar you take from a customer, you're giving them back 10 cents. Actually, you're giving them back $1.10. You're giving them back their dollar plus 10 cents. So you're actually paying someone to be your customer. So you always want to have high net profit. The higher, the better. And most industries operate according to, if they're not requirements, it's just how they normally operate. So it's often that you'll see that, bars and restaurants, you're often keeping 5 to 10 cents on the dollar. Grocery stores, you might be keeping 2 to 5 cents on the dollar. If you're a consultant, you don't have a whole lot of expenses, you might be keeping 90 to 100 cents on the dollar. Did we have a question from the audience? I didn't want to overtalk on someone.
If I may go back a little bit to your earlier question about why you might want to do your profit and loss statements on a monthly, quarterly, biannually or annual basis. I was looking at, so your cost of goods sold, you're probably going to have every month, there's going to be money that you're spending on that. But when you start listing those expenses, then you have some expenses that are going to be monthly, some expenses that are going to be quarterly, some might be biannually or annually in terms of like your insurances, things like that. So I think that feeds into your earlier question of why you want to look at a profit and loss over a longer period of time. You just want to know what your sales were for the day or even the month, then that's a different report.
That's a great point. Like a lot of times people will try to understand their sales from a point of sale system. So maybe if you're in a business and you're using like Square or Clover, one of those systems to accept payments from customers and track your sales, they have really great reports about all your sales activity. Whereas your accounting system takes both that and all your expenses. And like Eric is saying, is like sometimes you might have an insurance thing that you pay an insurance premium for an entire year. So that's going to be one time, that's at one entry. So you want to look over that time period for a year because you want to understand how your business is doing. But then there's other things like if you're in a retail store, maybe you get shipments every single week of things that you're reselling. So that would be, every week you have a cost of goods sold entry. So that's a great point, Erica. Is there any value to looking at a profit and loss statement that covers more than 1 year? Like a 2 year? I mean, like over, like it says, like this date ranges from January 1st to December 31st of 2 different years. Is there any value of having that long of a date range? And I'll just answer. Well, I would say yes and no. Like it would tell you, okay, over the last 2 years, I've made X amount or I've had X amount in expenses. But generally, people are thinking about a profit and loss statement on a yearly cycle because that coincides with tax returns. So that's very common, is that people kind of want to understand their business year by year. Or if you're going to do more than 1 year, you would separate it by each year. And I think that's Lance's next slide is if you want to do a multi-year analysis, it's very common to see it separated by years. it's not that you would lump all of the 3 years together because you would have a lot of understanding what's happening in your business if like the total sales, I'm looking at income here, it's like $1 million in sales or more. Well, does it really help you to understand that you've had $1 million in sales over the last 3 years? Maybe, but you probably want to know what's happening year by year. Like, is it going better, going worse, et cetera? And I'll let Lance talk on the horizontal analysis.
Yeah, during each one of those cycles. So true, isn't it? Very, very true. So now, yeah, if we look at this horizontally with those set time frames, it's a lot easier to understand than to just like Daniel, you just said, group them all together. Well, it's they're grouped together. What we're looking for here are trends. So let's assume that year one of this business, they're just starting out. They're just getting their feet off the ground. And so let's look at the sales trends, and anybody can chime in. If we look at sales, gross sales from year one to year two, does that look pretty good?
I would say yes. That's a huge increase. It's all not quite double, but it looks like almost getting to double.
Yeah, and then it sustains itself. So you almost wonder, if you just started out in the business and you were looking at your financial projections, what you thought you were going to do, this is a great way to look and say, did I hit the numbers that I thought that I needed to hit? Because in this case, maybe this business only was open, for the first 8 or 10 months. They were just starting out, and they, year two, from their projections, what they wanted to do, they were able to reach it and then actually sustain it over time with a little bit of growth later on.
Yeah, I would wonder
Another
from
way,
this, just from that sales increase, I would wonder if maybe they got started and they entered into the business market and they did really well. By the second year, they had kind of reached their capacity. By year three, maybe they
yeah,
had raised their prices a little bit or maybe gotten a few more customers, but maybe they just don't have a lot of either labor or equipment, or maybe there's not enough people to buy from them to grow at that same pace. So it could be that they've kind of stabilized or plateaued at that level of around 470.
good observation. Very true. And then let's kind of, my mouse right now is giving me a hard time here. Then let's look at another trend here horizontally, our cost of goods sold. Again, if we're a restaurant, a brewery, we want to be in that about 1/3 cost of goods sold, right around 66, 67% gross profit margin. So when we look at this trend right here, if we look across cost of goods sold and we did the math on that, we would see that we're at about a 28% cost of goods sold consistently, which for the industry is good. But if we would have all of a sudden saw our cost of goods sold in year two skyrocket, profitable with a reduced gross profit margin. So everybody looking at this one, does it look like we're in pretty good shape as far as our gross profit trend?
Well, one thing I noticed is that the sales increased like what, $9,000 ish, and our gross profit increased like 6,000.
Mhm.
So is that good or bad?
It could be either, couldn't it? Because maybe our trend, maybe what we're aiming for is maybe we took on more employees down here. Well, actually, that wouldn't affect it. Um, just trying to think, Daniel, did you have an observation that you saw there?
Well, what I might do is I might I might know I want to do the percentage calculation of my gross profit, because when you're just looking at raw numbers, sometimes like you showed us on that screen, like all of a sudden you got all these numbers flying, it's overwhelming. So it's pretty common when you're looking at one of these statements to use percentages so that you compare year to year. So for example, if I wanted to know what my gross profit percentage was for year two, I would divide 334,976 by my total sales. And I'm going to get my calculator out because I can't do that in my head. So I'm just curious. 334,976 divided by 468,599. So that's a 71.5% gross profit margin. So I could use that same percentage then to compare it to the next year, 341,310. divided by my sales of 477,570, it's 71 and a half. So what I would say, it's the same. So the way I'm buying my stuff to resell it, I'm doing that consistently year to year. Whereas sometimes you might see that gross profit margin either goes way up or way down. That would tell you that somebody's becoming a lot more efficient, or they're not keeping up with price increases and things are going askew with just the underlying business idea. I'll
Mhm.
give a specific example. I was working with a restaurateur, and we were looking at their financials over a period of like 5 years, and their gross profit margin kept shrinking and shrinking and shrinking. But their sales were going up. And I said, well, like, you're obviously doing really good sales. When's the last time you changed your menu prices? And they said, oh, it's like 7 years ago. We've never changed our menu prices. Well, over that 7 year period, all your costs are going up. But if you're keeping the same price on the menu, you're making less on every item that you're selling. So they weren't really even aware of it because they weren't monitoring these different parts of their financial statement.
Big point.
Daniel and Lance, one other thought that I'm having as I look at this, so your initial year is gonna include startup costs, equipment costs, things like that. Would it be fair to say that you would look at year-over-year comparisons and look at your percentages with an eye towards the life of that initial equipment? So say, for instance, your pizza oven has a 5 year lifespan, and you can see over 3 years what your profits are. And should you not also be looking at it and say, okay, cost of a pizza oven might increase by 3%, and in 5 years, I'm gonna need a new one. So rather than having everything dip the way that it did in year one, if I'm setting aside a portion each successive year until we get to year 5, then I'll have enough to purchase that equipment without it drastically impacting the bottom line for that year.
That's a great point.
Absolutely.
And so the way you try to account for things like equipment purchases, if you're buying something that is going to last you a long time, you actually don't list it all in the year that you buy it. You do what Erica kind of referred to, which is depreciation. You split the cost of that item over a few years. So in this example, we see a depreciation amount of $19,000 per year. What this business owner has done, they probably bought something that was worth $100,000, and they split the value of that over a 5 year period because they thought the equipment would last 5 years. So every year they're writing off a fifth of that cost. So the purchase of that equipment's not actually listed in year one, even though that's when it happened. You're trying to split the cost over a 5 year period to better understand the length of your business and the useful life of that equipment. The items that are here on year one, though, that could be true startup costs is like loan closing fees. That you see it only happening one time in year one. We also see starting inventories. We paid money to buy inventory. That only happened one time. So those are one-time expenses that are not going to recur, probably. Those are just to get you going. So that also can happen, is where sometimes in the first year you have costs that you're not going to really need to incur again, or it might be a long time before you do. And that's the importance of looking at all these statements, because for you to really understand your business, you have to be looking at these statements all the time, both monthly, quarterly, and annually.
Yeah, and that brings up a good point, because if you look at net income down here and you were to look at it, parentheses in bookkeeping or accounting is a negative number, you have to put it into context, don't you? Because yeah, advertising costs that first year, they were higher. And like you mentioned, Daniel, the starting inventories, there were some repairs and maintenance maybe that needed to be done. Like in this case, maybe fire protection had to be added. And then that was almost cut in half in the following years. So to be, utilities were always running about the same, but we didn't have the same amount of sales because maybe again, we were just starting out. Maybe it took us a while. So really, is it that bad to show a loss in that first year? Well, probably, preferably not. But if you put it into context and say, oh, that's why. And then as we look across it horizontally and say, are we making progress in our net income? Well, it looks like it's going up.
Mhm.
True?
And you're talking now about specific cost trends, meaning like line item, like what is happening for line item year to year? Like just at a glance, I see, like you said, okay, our utilities are generally about flat. That's, we know what our utility bills are going to be. But our wages line, it looks like we're expanding our staff. We started off with 90,000 in wages, which could be like what, 2 to 3 workers. And then by the second year, it looks like we must have hired somebody. So it helps you understand the business. All these numbers really tell a story.
Absolutely. Just trying to think of anything else really glaring on here. I think we've got it covered. Talk a little bit about the balance sheet. Now, like with the profit and loss, we're looking at periods of time. Again, months or quarters or biannually or at the end of the year. But the balance sheet, what's the strength of my business as of a certain date? And what's it going to include? The things that I have, that I own, hopefully, that are possessions of mine, the things that I owe people, the money that I owe people. So we're talking about, what do we have? Assets. What do we owe? Liabilities. And then what portion is ours as far as equity within the business? So on a balance sheet, what's not included is the time range. It's an actual date and time, one day. And it does not include we don't learn anything from the balance sheet in terms of the income or the details of the expenses where the money was spent. So let's take a little look at this.
Yeah, can we just stay back on that side for just a second? If you've never looked at a balance sheet, what the right picture is kind of explaining is like, okay, let's say that you have a house that's worth $100,000. So that's what you have. That's on your balance sheet as an asset. That's something that business has or you have. Let's say that you owe a bank $80,000. So you might have this house that's worth 100, but you owe a bank 80. The 80,000 is something that you owe to someone else. That's a liability, a loan. So what's the difference between that? If you sold the house today and it really is worth $100,000, what are you going to get at the end of the day? Well, you're not going to get 100,000. You're going to get the 100 minus whatever is owed. So that would be 100 minus 80. That's $20,000. That's kind of the idea of equity. If you ever heard the term home equity, it's saying that's the idea is like your house might be worth something, but you might owe somebody else on it. So the difference between that is your true value of your home for your purposes. And that's what a balance sheet is kind of showing you. What is my balance? What is what does my business own? The house. What do I owe in my business? All the loans or debts that I have. So what's my true equity? What's my value of my business if I closed it today?
Excellent. So let's look at a balance sheet here. And you can see it's a specific date. There is no date range there. What are the things that I own? Well, I've got cash in the bank. I've got other assets, and these are things that could be converted into cash easily within a year. So it may be like our accounts receivable, AR, people owe us money. It could be our on-hand inventory that we have that has value. It may be the company has some investments that they have out there that they're trying to make some money on. So assets, current assets or short-term assets, right? They can be liquidated. Hopefully, we could sell them within a year. But
Can
when
we
we
talk
get
about a
the
specific example about an assets for, let's say, like I don't know, a retail store? It's like, what would the actual assets, if somebody was renting a location, so they don't own the building, what would the assets of the retail store be?
the cash in the bank, the cash in the cash drawer, the inventory.
Yeah, anything on the shelves. It might be
Yep,
the shelving itself. Maybe they own the shelves. So
yep.
that could be another asset that they own.
Things that could be sold quickly.
Yeah.
In long-term assets, that would be things like your PPE, your property, plant, equipment, your building, um, maybe vehicles,
Yeah,
that
I
have a
guess this
long
this
life.
example doesn't show long-term assets. It just shows the shorter term ones. But yeah, anything that your business owns would be that total assets line.
Yeah. Then we get into liabilities. This is, what do I owe other people? Current liabilities are liabilities due within a year. So in other words, maybe you've got accounts payable, AP, right? That from your vendors and suppliers on things. It could be your short-term debt that's payable within a year. And I'm trying to think, then our long-term liabilities would be like maybe we've got that big loan out there, that $100,000 loan. How much do we owe on it? Other things as far as current liabilities too, that one that people forget, I want to point this one out is because this is a common one, and I know probably Erica, Nicole, and Daniel, you've seen it before, is current liabilities due within a year, sales tax,
Oh my gosh,
payroll
yes.
taxes.
Hmm.
And many, many times people are not looking at, what's going to be due within the year based upon also how much cash, how much liquid cash do we have, and get out in front of these and realize that money is going to be due.
Yeah, can I give a specific example? So it's very common that when you're registering for your sales tax license, the state will tell you, well, we're going to let you file an annual return. That means that for an entire year, you can collect sales tax from your community and then you'll owe us at the end of the year. Well, if you're not looking at your financial statements very frequently, all that money is going into your bank account. And I've seen it happen countless times where people use that money. So they'll say, oh, I've got, $5,000 in my bank account. I'm going to spend it all without looking at your statement to realize maybe 4,000 of that is not your money. That's the money that has to go to the state. So you spend it, the year is over, and the state starts calling. They say, hey, we don't see your sales tax return. Are you going to file it? And you say, oh, yeah, let me file it. So, oh, wait, I owe $5,000 now and I don't have any money in my business bank account. It happens all the time. People go bankrupt within their first year because they weren't planning on the money and they spend the sales tax money before they had to file. So very important to be looking at these reports so you know on a month by month basis, okay, how much am I kind of building up that I owe the state? So yes, I might have 10,000 in my bank account, but not all of that money is mine to use. I need to make sure that I'm keeping back 5 grand for when I have to pay my sales tax.
Yeah, and two organizations that never go away is the Michigan Department of Treasury and the IRS.
Yep.
They don't go away. Then did somebody want to say?
No, we were just agreeing with you.
Oh,
Yes.
okay. Then equity again, like Daniel, you were saying earlier, how much equity do we have in the business? Well, in this case, it's none, except for the total retained earnings, which is the net income from the previous profit and loss. Does that make sense?
So according to this balance sheet, if I closed my business today, do I have anything to my name or not?
Well, you got $3,600 here, but you owe 2,700, right?
Hmm. So on paper, I should walk away with what? If I closed everything and sold off everything that I had and paid off everybody that I owed.
Hopefully this 925, right?
Hopefully. What could affect that?
If maybe these total other current assets, I can't get $2,000 for them.
Yeah, exactly. So like that, the 1,600 that's in the bank account, yes, it's absolutely there. The other current assets, that might be things that other people owe me. So like you mentioned, if I had sold something to somebody and I said, well, I'll bill you later. And so then I bill them, but they haven't paid me yet, there's a chance that I may never get that $2,000. So if you truly are liquidating your business, you're hoping to get out the equity or better. But sometimes there's cases where when you actually liquidate everything and you're trying to sell or trying to collect what you owe, things things could go askew.
Yeah, and you sell things in order to be able to sell them, you might have to sell them for less than what you thought they were worth.
Exactly.
That's
Yeah,
right.
like that total current assets of 2000, maybe that includes your inventory, which maybe you paid 2000 for it, but when it actually comes to sell, you have to have a fire sale because, you got to close today, maybe you only sell it for 500. Well,
Yeah.
that $1,500 difference, you basically you've lost money on this business idea. You would actually have to pull money out of your pocket to pay off the loan because you wouldn't have enough to pay off the loan.
Want to make one other comment too, as far as the profit and loss and balance sheet reports is when the time comes with good record keeping and you do go to try to sell your business, savvy buyers are definitely going to ask you for your past, profit and loss balance sheets in the form of tax returns. So that's another really important reason why record keeping is totally important. Vertical analysis, going up and down on the balance sheet. Oops. Oops, my mouse for some reason, I'm apologize, but so there we see again in the bank account, there we
So,
find out that $2,000 was inventory.
so that first report was like a summary, but this is showing a little more detail. So it's the same numbers, it's just a little expanded.
Yeah, we found out that $2,000 was that inventory. And again, is it going to be worth $1 for dollar for what we paid for it? Probably not. And then we find out, the long-term liabilities, it was a loan. And then there again, we show that equity, the profit between that range of time from the profit and loss.
Can we go back one, Lance? So if you're talking about understanding a balance sheet, just a quick analysis, if you're looking at a balance sheet, like what should the key things be that you're looking at? Well, if it were me, I would want to know, do I owe more than I have? So are my liabilities bigger than my assets? If I showed that my liabilities were like $5,000 in this example and my assets were $3,000, what would that mean? It means that I owe people more than my business is actually worth. You don't want to be in that scenario. So that's why looking at this balance sheet periodically, as of a certain date and time. Okay, on the last day of this month, do I have more than I owe other people? That's a very quick analysis. That's called your liability to asset ratio.
Excellent. Let's look at the balance sheets horizontally over time again. With the same, hopefully, right, cycles of date, end of the year, end of the year, end of the year, right?
Mhm.
So there again, if it's me, I'm looking at it, what's the cash trend happening in the business on the balance sheet? Well, it was 21,000, it went to 71,000. Now in year 3, it's up to 122,000. Looks like
That
a
sounds
good
pretty good to
trend,
me.
doesn't it?
Yeah. I'd be
Yeah.
happy if that was in my business bank account.
Yeah. And then other current assets, and this is one number, it hasn't changed. This might be a steady inventory that's always been there. Pray that maybe that this isn't accounts receivable that's been sitting there for 3 years, right? If we've got other current assets and we were looking in great detail at it and we found out, oh, that was accounts receivable and people have owed us money for 3 years. Ooh, that's doesn't sound good, does it?
Yeah.
Um, my mouse, I'm sorry, you guys here. And then just looking at, total current assets overall, what's the trend? Well, they're going up, and why is it? Because of the increase in cash. Fixed assets. I got a question for anybody here now. Say one of our fixed assets was a building, and we only had our original loan. Why is it that our fixed assets are actually going down in value?
So are you asking why the building is showing that it's worth less each year?
Yes.
Ooh, I think Devin's got it. Depreciation. It's the
Yes.
idea that in accounting you can show wear and tear as a monetary figure. So let's say that you buy a building for 500,000 and you could see that the change in this is about 20,000 per year. If you divided $500,000, what you paid for the building, if you divided it by that $20,000 change, what would that be? Is that $25,000 or 25 years value? Give
Mhm.
me a second. Let me get my calculator. That's
Oh,
I never try to do math in my head. $500,000 divided by 20. Yeah, so it's a 25-year useful life. So in accounting, you can say, well, if I think this building's going to last me 25 years, I'm going to write off a 25th of the value every year.
Then we have our other assets. These could be maybe things like, oh, I don't know, trademarks, copyrights, patents.
I just want to make another comment on depreciation again. So why would you want to show that your property is worth less over time? And I'll give the answer. There's two reasons. One reason is for true management of your business. If you had to buy let's say you're a landscaper and you need to buy a big riding lawnmower, and you say to yourself, it's only going to last me 5 years, you would want to understand that for every year, you need to be reserving a fifth of the value of that cost in your bank account because you're going to have to buy it again. So Erica, I think even mentioned that before. It's for long-term capital
Yes,
planning, is that you need to know how much value you losing each year because you got to plan for the future. Another reason, though, is for taxes. The IRS allows you to write off a portion of the value of those big assets that you're purchasing. So you want to show that they're losing value so that you can write that off as a business expense, and that's totally legal. It's called depreciation or amortization. Those are both terms that describe the idea that if you buy something really big that's going to last a long time, the IRS does let you write off a portion of that value each year so you can reduce your tax liability. So it's both for managing your business and also paying less taxes.
excellent.
Devin's got a great question. Does the business determine the rate of depreciation 5 or 10 years? And the answer is yes and no. So for management of your business, you can say, hey, if I really think this is going to last me 3 years, I'm going to write off a third of the value in my internal statements. But when it comes to tax time, the IRS has their own guidelines about how quickly you can depreciate things. So you have to use the IRS's tables. So what you do is you take your internal reports, you say, okay, this is what I think my business is really going to do. You take that to your accountant, and your accountant says, okay, I understand why you did that, but for IRS tax return purposes, we need to make a few adjustments. You can't say you're going to write all of this off in 3 years. We need to do it over 5 years or 10 years. And the IRS has all kinds of depreciation tables that says, okay, if you buy this type of equipment, you can write it off over this period, et cetera, et cetera. It's very detailed. So that's a great question, Devin. So the business owner decides internally for their own planning, but when it comes to tax filing, the IRS stipulates what you have to do.
And it's important too, again, having a CPA to do your taxes,
Yeah.
and to consult with, because there's some years where, depreciation, if the Congress passes a law, they could say you could do accelerated, depreciation, which you might not have been able to do, in years past.
Yeah. I've
The
seen
laws
people be able to
change.
write off 100% of the cost of the equipment in 1 year for tax purposes, but then for planning purposes on their internal statements, they say, well, this is actually going to last me 5 years, this lawnmower. So I want to show a 5-year depreciation so I could really plan my business out.
Good points. We get into current liabilities, again, money that's owed within a year. And on this one, this is interesting because year one, it's 18,373. Then it goes to 19,567. Then it goes to 2839. Anybody got any observations on how that might be? It's like, because it doesn't look like, I'm just trying to think. It doesn't look like we purchased any other additional assets. So why would this be this way, Daniel?
So in this scenario, most likely somebody bought a big building and they got a big mortgage loan on it. And so you can see the total liabilities, the total loan balance is going down over time, but part of that loan is due within the next year. And what happens with big loans is that you start off by paying more in interest and eventually start paying more in principal. So on a balance sheet, you'll often see that the current maturities, which is the principal portion of a loan, is actually increasing, and that's because more money is going to be allocated or has been allocated to principal instead of interest. So you don't want to get too
Excellent.
caught up in the current maturities versus long-term liabilities if it's the same loan. I would be more interested in the total liabilities, which is describing the total money you owe other people. And what I like about this trend horizontally, you can see that every year you owe less to somebody else. So your assets are going up, your liabilities are going down, and that's good news for your equity, which is your true value in the business over time. It's going up. which is great to see.
The value of the business increased as well as how much of it is yours, how much of it is equity.
Exactly. Yeah. That's good on all fronts.
Cash flow. It's all about cash flow, right? The cash flow statement. This one has a time range to it. And what's it trying to do? It's trying to track the cash that comes in and out of the business. What did we start with? And then what flowed in, what flowed out, and how much cash is there at the end of it? What it's not going to include is non-cash expenses. Again, things like depreciation. Depreciation isn't a true cash expense, right? So we can see the water flowing, right? Cash coming in, cash going out. There's three ways that cash does flow through a business. One is, financing. And that's like through our loans. That's our money, loans, owner investment to finance things that we need. The actual investing in buying assets, and then the cash that we consume with our operating expenses as we conduct business, as we're turning wrenches.
And can I make a note here that all of these three ways that money moves in business, they can either be positive or negative, and I want to talk about each one. So financing, if you have positive cash flow from financing, that means that your business got money from somewhere. So positive financing means that either you got a loan or you took money out of your own savings account to put into your business idea. That's positive financing. On the flip side, what would negative financing be?
Be the cash going out to make your payments, right?
Yes, paying down the loan. So that's negative cash flow because your money's leaving your business to pay off what you owe, or taking money out of your business to put in your own pocket again. Those are owner draws. So that's the positive and negative, the financing aspect of money in business. The investing can also be positive or negative. If you are buying a vehicle with money from your business, is that positive or negative cash flow?
Well, the money's going out.
Yeah, money's going out, so it's negative cash flow. So you're exchanging cash that you have in your bank account for a vehicle that's going to be sitting on your lot. So money went out. That's negative cash flow. How would you have positive investing cash flow?
I'm trying to think if you sold
Yeah,
some of
if
your
you sold
things.
that vehicle, if you sold that vehicle that was on your lot and you sold it, then that's positive cash flow. So the vehicle's gone now, but you do have the money for it. So that's an example of positive investing is actually selling off assets, which sounds it's a little bit weird. Like, okay, so if I'm selling something off, then I have positive cash flow. It can feel a little bit weird, but yes. And then also operating could be positive or negative. Operating is saying, am I actually making or losing money in my business? To have positive cash flow, your sales have to be higher than your expenses. So if I'm a retail store, if I sell a widget for $1 and I paid 50 cents for it, that's positive cash flow. If I had negative operating cash flow, what would that mean?
Paid $1. I paid $2 for it and sold it for $1.
Yeah, I overpaid for something and I wasn't able to sell it for what I paid for it. So I'm losing at the business idea. So that's negative operating cash flow.
So here we're looking at one again with the time range, January 1st through April 26th. Money came in from sales for $120. $4,000 went out to buy PPE, to buy some sort of an asset. So our net cash from investing would be -4. Financing, we were able to get a $5,000 loan, and the owners or shareholders invested $1,000. So that was $6,000 of positive cash coming in. Oops. So if you take the gross cash flow inflow coming in minus the outflow, the $4,000 to make this investment. Change in cash is $2,120. We should have $2,120 in cash.
And if we could describe this as a story, so the first thing, the date range. I see that this date range is January 1st of that particular year to April 26th. If I had to guess, this business owner was pulling this report on April 26th because on April 26th, they said, you know what? I started my business this year and I want to know how things have gone so far. And if at the very bottom, that overview is telling the story. So the business owner says, okay, I started on January 1st with $0 in my business. So that's the very first line, starting balance 0. I've $6,100 is what's come into my business, 4,000 has gone out. That detail is from up above. So what has happened in this instance? Well, positive cash flow came from the financing activities. I must have gotten a loan for 5,000 and I also must have put $1,000 of my own money into the business bank account. So my business bank account after I started my business should have had 6,000 in it. What did I do with that 6,000? Well, I invested in some things. What did I invest in? Equipment, maybe shelving, or could be inventory. So 6,000 I started with, I paid out 4, so I should have 2,000 in my bank account. And that's for my day-to-day work. What is my day-to-day work? Well, it's making sales and paying my business expenses. After all that was said and done between January 1st and April 26th, I came out $120 more than I started with from that 2,000. So now I have 2,120. So that's my ending balance. That's the story that this is telling. And is this good or bad? And Lance, your assessment, did this business owner, were they successful?
Well, I would say it depends what's going to happen down the road yet.
Yeah, but I would say like from your standpoint, this so far, this is what I would say. I think they've done a good job so far, and here's why. They were able to get somebody to back their idea with a loan. They were able to invest some of their own money. They were able to use that to buy the equipment that they needed. And for this date range so far, they've made more money than they started with. So it's positive. Operating activity, it's positive. They're making more money than they started with, and they haven't had to sell off equipment because they're short on cash. It looks like they haven't had to get any other loans. So I'd say from my perspective, so far they're doing okay.
Got this thing in my way. I apologize. Let's see. Now we have two different, my screen, I can't see the top, but hopefully we're looking at two different companies right now, aren't we?
Yeah, it's a comparison of two different people that have the same amount of ending cash.
Yeah.
So
So if
at the
we,
end of the day, each of these businesses have the same amount of ending cash. And the question is, which one of these businesses did a better job? Is it the same or is it different?
so let's take a look at it. If we start at the top with sales and we go across, business A only had $120 in sales. Business B had $10,000 in sales. So far B looks better, right?
I think so.
But yet a lot of the same things happened. Business A expended $5,000 on property, plant, and equipment. Well, so did business B. Both the same. And again, they both have the same cash at the end. But when we go to the financing part, owners A had to put in $7,000 of their money, but yet over here, business B was able to take out $3,000 of the cash as an owner draw. This one over here was owner investment, maybe a bank loan or something. So this one had to spend money. This one was actually able to take money out.
Mm-hmm.
They both started with 0. but the gross cash inflow from business A was primarily only the $120 in sales and the $7,000 of financing. Whereas we can see with business B, they were able to get sales. They got sales going. They were able to hit the ground running, which as a result allowed them to take $3,000 out. But in the end, they both end up with the same amount of cash.
Yeah, this is a tale of two businesses. It's funny how they both start with $0. They both end up with $2,000, but one business did much better than the other. And the way you see that is through that financing activity. Business B was able to give $3,000 overall back to the business owners. Business A, the owners invested money in their business and it's still in there because they're not doing too well. Their sales are not keeping pace with their competitors.
That's exactly it. And that's why you'd have to talk to somebody like Nicole Potvin as far as marketing and saying, why the heck aren't we getting any sales? We got to get some sales on this one, right?
I will say that the statement of cash flows is kind of the hardest report for a new business owner to read because it takes a little bit of experience. And a lot of business owners only look at the profit and loss statement. And if they're more savvy, they'll also look at the balance sheet. Not a whole lot of business owners look at this specific report called the statement of cash flows. But in my opinion, it's one of the most important reports, and it gives you a really good sense at a quick snapshot if this is good or bad. Because the three ways money moves in business, you always want positive operating cash flow. You always want to say, my business knows how to make money. Investing activities, you often want to see that it's negative. What a negative investing activity is telling you is like, hey, I'm able to keep buying equipment and materials and big assets from my company so I can keep making it grow. So it's very common that yes, you want positive operating, negative investing. Should financing ideally be negative or positive over time?
Well, negative, hopefully.
Yeah, and it feels weird to say I want negative cash flow, but you want negative cash flow for financing activities, which means that I can pay down my loans and I can also take out draws to go on a cruise. So the ideal scenario in business is that you have positive, negative, negative, meaning positive operating cash flow, so I can spend money on equipment and also pay off my loans and take money out to go on a cruise.
So what can you do today? Open up and use your business bank account. Don't commingle your personal funds with your business funds. The business is its own entity. Even though you personally invest money into it and you personally take money out of it, you still should account for it and categorize it. There's nothing wrong with taking money out of your business, but it should be categorized as an owner's draw.
And I can't tell you, Lance, the number of clients that I've worked with that I'll say, okay, are you like their new business? Are you doing good or not? And they'll say, I'm not sure. I said, well, let's look at your bank account. If you don't have actual formal reports, let's at least look at your bank account. And they give me their personal bank statement. I'm like, whoa, 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 whoa. You've got your groceries, you got your,
Yeah,
going out to the movies, you got gas that you're buying. What does that have to do with their business? Well, it doesn't. That's the importance of having a separate business bank account for any business activity. Because without that, you're going to get lost in the sauce really easily. You'll never know if your business is doing well or not if all your money is mixed together with your personal money.
absolutely. And it's not uncommon, for a startup business to say, I use some of my own money and everything, and I don't have a business bank account yet. But, again, if you're tracking all your receipts and any money that you've made and any expenses that you have, quickly, initially, quickly, book that as an owner investment. If it came from your personal, open up that bank account and make the business its own entity as soon as possible.
Yeah. It's never too late to open a business bank account if you haven't done so yet.
Yeah. And get an online access to your bank account so you can see it in a timely manner. So you don't have to, wait, for a monthly piece of paper to come in. Because
Did
at
we, did
that
we have a question from Erica or someone I didn't want to talk over?
You have a question? No,
I think we're good.
I think we're
Oh,
good.
okay. I thought I heard a noise.
Yeah, so definitely, a bank account that you can access online.
And Devin, thank you for your message and thanks for joining us. And this will be recorded, so I think you can harken back to it later if you need to get the rest.
Yeah, and then start using an accounting program, something. Use a professional. Us at the Small Business Development Center, you probably already sensed already, well, Lance isn't no bookkeeper or CPA. You're right, I'm not. I know enough to kind of help to coach you along a little bit and what to look for. But you definitely eventually initially you want to have a CPA in your corner. Ideally, to have your bank statements, the ability to download your banking data directly into your accounting software, your bookkeeping software. That's really nice because as long as you're not commingling funds anymore and money coming in and out is all business money and it's connected online and it goes into your program, well, then that's all you're going to really need to do is once a month or at a certain set in time, you're going to go in and reconcile your bank records and categorize all those transactions. Were they for cost of goods sold? Was it for a payment on a loan? Did I break it out to show the interest that I paid on it? So, so having a connected bank account into your accounting software is really nice. So then once you're able to do that again, like we've discussed today, then you're able to pull out reports and review them and analyze them, and you can start to plan and to try to get better. Again, get free help. We're free to you at the SBDC. We're here to help you. We're not going to do your bookkeeping for you, but we'll help you. We'll be there with you along the way.
We'll teach you how to do it and how to read the reports. Could we go back one slide? I wanted to make our question and also comment. How frequently, you mentioned, I thought I heard you say, how frequently should you categorize transactions?
Yeah, I think it depends on the business. I think for some businesses, do you do it weekly? I think at a minimum once a month.
Yeah, minimum would be once a month. And if you have a lot of activity, then you need to do it weekly. You probably don't need to do it daily. But when I say a lot of activity, let's say that you run a daycare. You probably don't need to do that every week. Maybe once a month, you look at your bank statement and you categorize all your transactions. Okay, these were sales I made from the parents. This was my light bill. This is the food I bought for the kids. Once a month is probably sufficient. If you're a high volume retail store or a restaurant or bar, you got to be doing that every week because you're going to have hundreds of transactions to get through the month. You're going to have daily sales. You're going to have all kinds of payments to your suppliers. You're going to have maybe lottery coming in and out. So there's a lot of activity that's hitting that bank account. You don't want to wait till the end of the month because that'll take you hours.
In something to, oh, go ahead.
If I may, it may also depend on your business. If you have a seasonal business, in season, you probably want to do it weekly. Out of
Yes.
season, monthly.
Yeah, for sure. Let's say that you're, a Christmas tree farm. Well, for the months of November, December, you better be going in there every week. But in April or May, there's nothing going on. You don't need to do a lot. So that's a good point.
And to stick yourself to on a schedule, if it's weekly, do it weekly.
Oh my gosh, yeah.
If it's monthly, stick yourself to that schedule. Every, last day of the month or the first day of the following month, I'm doing it and I'm always going to do it. I laughed at one of my really good friends one day. He had a convenience store and he says, I always stuck to my schedule. And there was one time, I always did it once a week, convenience store, once a week, every week. And he said, I skipped about 2 or 3 weeks. And he said, after the mess that it created and the hassle, I went right back to my once a week, every single solitary Friday. So,
Yeah. And I have a couple phrases I use often. One is that accounting takes the same amount of time whether you do it or not. So what I mean by that is, if accounting takes about 5 minutes a day, to be honest, for most businesses. If you wait 365 days, it's going to take you 5 times 365 days. So the amount of time, it's not going to go away. So it's better just to do it on a routine schedule. Another thing I like to say to people is opening your accounting program is just as important as unlocking your physical doors in the morning. If you say, I don't have time for accounting, what I would say is you don't have time to open your doors then because you don't know how to run a business. keeping track of your money is just as important as actually being in your shop and opening the front door.
And, anybody have any questions, comments?
Quick question. So if you have an accounting program, whether it's QuickBooks or Quicken or any of those things, how often, depending on your business, should you be talking to your CPA? Is it just gonna be at tax time? Is it just gonna, you're gonna wanna check in with them once a year, or when you have to make specific kinds of purchases or draws? What's the thinking there? When should you seek professional help?
Quarterly. So when you're starting your business at the end of every quarter, and quarter means like January, February, March is one quarter, and then so on. So at the end of every quarter, you wrap up that quarter's activities and you send your accountant your profit and loss statement for that quarter. The reason is because sometimes they'll say, "Oh, you're doing fine. You don't need to do anything. You're not making enough money, or things look fine." Other times they'll say, "Wow, I think you've been miscategorizing things, and we need to get back in there so you know how to better handle your finances because you're doing things wrong in your accounting system." Or they might say, "Man, all your accounting looks really good, and you're making tons of money. You need to pay in some estimated taxes because if you wait to the end of the year, the IRS might penalize you because you're doing so well and you haven't paid any taxes in." So that's another thing they might say is, "Hey, based off of your activity for that first quarter, we need to send $10,000 to the IRS now to avoid any penalties or interest in the future." So I'd say quarterly is a good cadence for corresponding with your accountant. Monthly is generally not needed for accounting purposes because tax payments happen quarterly generally. So that's my feedback and my experience. Anybody else
Yeah,
have
and
any other?
I would say at first, I would say at first, and you first starting out, I would say early and often as you see fit, early and often. But at some point, if you're doing a good job in your business, then you begin to wean yourself off of the accountant. But a good accountant is worth their weight in gold, in my
Yeah,
opinion.
we have a
And
shortage of accountants
early
in
on,
UP. Mhm.
and there's a huge shortage. Yeah.
And don't wait if you're starting a business, do not wait until tax time to try to find an accountant. It's too late. And when I say tax time, I mean as soon as January starts, that's when tax season starts because the year is over and everybody's filing their tax returns between January and generally like April. And accountants are extremely busy during that time period. So if you get a new business and you wait, you started in June and you're doing all the kinds of activity, and then you say, "Okay, now the year's over, I need to find an accountant," it's too late. You're going to get all kinds of people saying, "We're not taking new clients right now." So as soon as you start your business, you want to start talking to potential accountants because you want to get on their radar.
Right on. Any other questions?
It was really informative. Every time I see you guys do that, I learned something.
Yeah, thank you guys. It was great.
Me too. I'm so glad Daniel, our boss, was on today because I thought, hey, I got this, and then all of a sudden he said, well, I can be on there with you. And, I learned things again today too. So
Yeah.
excellent. It's
I'm
called
a
team.
I'm a bookkeeping and accounting nerd. I just love it. I love the numbers part of it. Now, marketing, I'm not great at. You got to talk to Nicole. But if you can make sales, I can get all your accounting done.
Perfect.
What I
So
appreciate most from you guys is putting in terms of real situations. So I think many businesses and me at doing books for a nonprofit, we start looking at all those statements and it's overwhelming.
Yeah.
And the terminology is overwhelming. Being able to take that terminology and say, okay, this is what it actually means for you and your business and what you're doing every day. This is the example. So thank you for doing that. It makes a lot more sense to me.
Thank you.
excellent. Thank you. Here again is our website. If there's anybody here online or people there at the meeting today, www.michigansbdc.org. We're here if you need help. And by the way, it's not just about bookkeeping. If you're looking to buy a business, sell a business, you're just starting up, you got questions, we're free, we're confidential. Just click on this little get started button right here. It takes you maybe 3 minutes. And then
Mhm.
that serves as our confidentiality agreement and that our services are free.
And also thank you from the Central UP Small Business Support Hub, otherwise known as the Hub. You can reach us at marquette.org/the Hub. We have lots of resources, and this recording will also be posted on that website under Hub Resources within the next few days. So thanks for joining us.
Yeah, and special thanks to the Hive for hosting today. Pizza was excellent. So guys, online, I apologize. We were eating right in front of you. It was delicious.
If
So,
you missed it, we got it hot, piping hot and fresh.
oh my goodness. So recommended, highly recommended. Thank you.
Thanks
Excellent.
all.
Take
Take
care,
care.
guys. All right,
Thank
bye-bye.
you. Bye-bye.
Oh, it was so good.